And you're up, Patrick. Thank you so much, please, for coming in and doing this. You're my first guest speaker, so I really appreciate you.
This is going to be amazing because there's a lot of bad information about credit and especially mortgage credit. So let me just share my screen and we're going to get after it.
Okay, awesome.
Go. Magical emails.
Oh,
Okay.
love it.
The PowerPoint, it's been pretty much the same for 13 years. So I try not to get rehearsed, though. I like to kind of shoot from the hip a little bit because who wants to hear a speech, right? That's no fun.
I hear you.
Yeah. So a little bit about myself. I founded Mortgage Ready 13 years ago. So we're one of the longest standing credit repair companies in the country. And we've had about a 20 to 30% growth curve per year. We really actually try to control growth, believe it or not. There's a lot of bad credit repair companies out there, and they're very turn and burn. Instead, we're being able to grow every single year. We never get too big. We never get so big we can't answer our phone type thing, or handle customers. And we have a 4.7 Google rating. That's something I'm really proud of because, I mean, I've been to Michelin-starred restaurants that aren't a 4.7, and we're credit repair. Yeah, we're credit repair. And the reason why we're able to keep that high rating is because we do a full free analysis. Every customer knows exactly, based on their exact file, what they need to do and what we're doing. And if you set good expectations for people and maybe under promise a little bit, they're going to be happy. That's a pretty simple formula, right? It's no secret that we're the best in the business at negative account removal. Okay. This is very important. We teach people everything they need to be doing on their end. But normally paying off a bad account doesn't help, right? If you pay off a car loan, it's got lates on it. Those lates stay there for 7 to 10 years. Same thing with a collection. If you pay off a collection, unless it is a medical collection, any other type of collection, paying it off does not help your score, and it can actually hurt your score. Everybody's probably heard that rumor that paying off a collection hurts your score. It absolutely can. That's true. And most credit repair companies really hide behind that fact, and they Did I mute? Okay, there we go. Can you guys hear me?
Yes.
Okay, perfect.
Yeah.
I don't know why I suddenly muted there, but the point here is that we're the very best at deleting negative items. And when a customer pays off a negative item, it sits there for 7 to 10 years if you do nothing about it. Sometimes it can actually lower score by paying off the wrong collection. And most companies hide behind that fact and they say, don't pay off anything because you could hurt your score. And it's true, you could. But other times, paying off a collection is the fastest way to get to a mortgage ready level. So what makes us different from every other credit repair company is when we enroll a customer, we create a written personalized optimization plan on day one that says what to pay and what to avoid paying. Very important. We want to make sure every move they make is a move in the right direction. And we put a date to pull. If they do what we say, their loan will be ready on that date to pull 19 times out of 20, believe it or not.
Can I ask a question of you, Patrick?
Please.
Because we're starting off here, which is important to us in the industry. So if we have somebody that's disputed an account, I know it's a tough one because we can't, especially with FHA, cannot close with disputed accounts over a certain amount of dollars. And so they want that dispute removed. Once they remove that dispute, you and I know that it lowers their credit score. And I'm assuming, but I'm not positive, it's because when it's put in dispute, it's not contributing to the algorithm. Is that correct or not incorrect?
Oh, I love that question. No, what happens is something a little bit different. If disputing an item excluded it from the algorithm, right? That's a very common rumor. Then everybody that disputed all their accounts would have 800s. And we see that doesn't happen. Instead, it produces a compliance condition code on that account, and it basically changes what information the algorithm is looking at. Sometimes it can lower score, sometimes it can raise score, but either way, we never dispute an item because it all comes out in the wash. Those disputes have to be removed before closing. And sometimes we have customers come to us and they say, my loan officer said, I have these disputes, help me, I need credit repair. And honestly, if their score is good to go, they probably don't need credit repair. They just need some good advice. We have a 1-day rapid dispute removal process that we walk the customer through. The customer has to make the phone calls to the bureaus, but having those dropped in a single day is not a problem. You don't have to pay those rapid rescore fees. So keep that in mind moving forward. We
Right.
don't dispute negative items, though. We create investigations under federal law, and we're forcing these companies to prove particulars about the account. That is both why it doesn't create a dispute and why it's more effective than just simply disputing things. If disputing things worked, we would do it.
So what about those people out there that have accounts removed that show back up later? Is that, like, I know a lot of credit repair companies say this isn't their account and they're given like 30 days to, like, you know, prove that it is, and then it's got to come off. And then if they find out it is, it goes back on. Are those some of the scams that we're seeing out there?
Exactly. And here's my thought is that this is kind of a weird line to walk, but it's not a scam in that the credit repair company is not causing the item to pop back on there. Okay. But it's really bad business to tell a customer to not pay off a negative item and somehow that's going to get their loan closed. I said before, sometimes you do want to avoid accounts, but there is nothing that can be done on heaven or earth to stop a bad account from showing up. You can do a credit freeze, you can do a fraud lock. There's nothing that stops a collection from showing up, ever. And so you want to make sure that as you're going through the credit report that you're looking at all sorts of different factors. We've been doing this for a long time, and we know which accounts that the customer should settle out and which accounts they should avoid. But realize when they settle out an account, that account will never repost. The only reason why the credit bureaus exist to begin with is to intimidate people into paying their collections, into paying their bills. That's what it's there for. It's that accountability piece, really. And if you pay off an item, and this is why we do this personalized plan, we tell people what to pay off and what to not pay off. And if they settle out an item, and we hold their hands through that, we tell them exactly what to say all the way through. Those items never pop back on because they're already settled by the customer. Does that make sense? Yeah. So that's what they do. They say, don't pay off anything and we're going to delete a bunch of stuff. And the customer sees some stuff coming off, but they never get up to a mortgage ready level. They never get their loan closed. And we would not have a 4.7 Google rating if we were over promising what's possible. I don't want to sign up a customer unless they know that there's, for example, 10 collections and they have to pay 4 of them off. And if they can't settle those things, then nobody can get them up to a mortgage ready level. It's not going to happen. I'd rather tell them that on the front end than have them find that out a few months later. Does that make sense?
Yep.
Yep. It's common. We see it. So it's the elephant in the room. I don't mind talking about it. But yeah, what makes us different? We're actually telling people what to pay. We put down a phone number, what to say as well when they call. Because if a customer calls a collection company and they say, yeah, my loan officer pulled credit because I'm trying to get a home, well, they're going to seem rich to the agent at the collection company. Prices are going to go up at that point, right? So we want to watch out what we say when we call them. We hold their hand through that whole process so that the loan officer doesn't have to deal with it. You just send us a name and a number and we got them from there. That's the idea. So let me talk a little bit about what a mortgage FICO is. Okay, I talked a little bit about my company, but a mortgage FICO is much different from online FICOs. It's much different from a generic credit scores. Okay, much different. Let me start at the very top. The credit bureaus themselves are holding data. And people always wonder, how does the data get there? Is there any law that says that my mortgage is supposed to post? Or, you know, how come my credit card is only on 2, but not 3 bureaus? Why isn't it on all 3? Well, here's the answer. Reporting is voluntary. TransUnion, Equifax, and Experian are private for-profit companies. And like every private for-profit company, their job is to make money for their shareholders on Wall Street. Where do they get their money from, though? TransUnion's a multi-million-dollar company. Where does that money come from? Well, they sell you credit reports every day through your credit vendor. Your credit vendor, whether it be Factual Data, Credit Plus, any of these companies, they have to pay TransUnion for that data. But the vast majority of money that TransUnion, Equifax, or Experian get come directly from banks and collection companies. If you want to post a date of last activity, a month reviewed, a collection, you have to pay money to the bureaus to have that happen. And this explains why errors are so common. It doesn't matter whether the information you're posting is right or wrong. It doesn't matter. The bureaus will take your money. right? They're in the business of doing that. And so really explains as you go through the credit report why the customer says, this is not my collection, that's my son's collection. How could we have the same collection? This makes no sense. Everybody's seen it, right? Well, the answer is really simple. Somebody paid money to make that happen. Somebody paid money. It's terrible, but money makes this whole system go around. It was created by the banks for the banks. But keep in mind that bureaus themselves are just holding data. And then all that data has to be funneled into an algorithm to kick out your credit score. Seems simple. But there are hundreds and hundreds and hundreds of different algorithms that will kick out your credit score. And I like to put them in two general categories. Number one, you've got all of the algorithms that Fair Isaac Corporation have designed. That's where the FICO abbreviation comes from. Okay. Now they create a ton of different algorithms that are not mortgage. They've got auto algorithms, credit card algorithms, insurance algorithms. You can go to myfico.com and get an online FICO score. And those are all within the FICO family, but those are not mortgage FICOs unless you have purchased a credit report from your mortgage vendor. And I'll explain exactly which algorithms they're using in a minute. But there's another family that are not part of the FICO family, and I just call them the generic credit scores. These are the Vantage scores that you can see on Credit Karma or Credit Plus or all these different websites out there. And you can't buy anything with that credit score. It almost has no value. You can't compare it to an online score. You can't compare to a mortgage score, rather. You can't compare online scores to auto scores. They're going to be a little bit different. And we normally see a higher score online than anywhere else. And people always ask me why that is. And my guess is simple. Credit Karma is a free app. You don't pay anything for it. And that makes you the product. They want to give you a high score. They want to give you the warm and fuzzies because they want to sell your information off to Capital One, to First Premier, to all the companies that have ads on the side of that app. So yeah, they want to give you a higher score than you see in the mortgage industry. Make sure your customers know that these scores are based on the same information that a mortgage FICO is based on. And we're going to get into all the factors in the next slide. It's really cool. But really important to understand that it's like comparing apples to oranges. And if you see one go up, the other might go up too. If it's a good season for apples, might be a good season for oranges, but you're not going to see a one-to-one comparison most of the time. Okay. Credit Karma is great. I have it myself. It's a good barometer. It's free, why not? And if I see suddenly somebody bought a $100,000 car in Florida, I need to know about it. So it's good to monitor my accounts.
That's how I do it too. I monitor with Credit Karma. It's like, oh, somebody checked my credit. They did not have my permission.
Yeah, I actually do that. I do, but I take that score with a giant grain of salt. Throw it over my left shoulder.
What about the scores that you see on your bank statements? Like Chase has a credit score. So that really messed me up big time. They gave me like a 796 FICO score. And when I went to do my refinance, I had paid off my lease and closed it out, and my credit score dropped 100 points. And they didn't catch that. And even today, they're always telling me, oh, you have an 804 FICO score. And I'm like, yeah, no, I don't. What about that score? How are these banks giving us credit scores without running our credit?
Great question. And so there's something called the soft pull. Essentially, they're paying the bureaus for the information, but you cannot buy anything with that credit report. That's literally the only thing that makes it a soft pull. Can't buy anything with it. But it gives them the information to put through an algorithm that gives you a number that you can't buy anything with, and you can't compare it to any other number. It's crazy. So
and it is true that a soft pull credit report score is going to be different than a hard pull, correct?
That depends, actually. It depends on the algorithm that you use. There are mortgage credit vendors out there that will do a soft pull, and they will put it through an actual mortgage algorithm. Okay. But the credit card algorithm that you see, it's kind of like Credit Karma. Track it over the long term. If you see it go up a ton, ask yourself, what factors made that happen? Where are my actual accounts? Is there a reason for that change? Because if you see that thing drop by 100 points, you need to know, right? But it's like comparing apples to oranges. Do not expect the same score when you go into either an auto dealership or an insurance agent or a mortgage loan officer or even to get a credit card, if you fill out a credit card application, they might put you through a different algorithm than the credit card company sends to you every month. I know USAA does it, Capital One does it, Chase does it. So those things are just for entertainment purposes only, to be honest with you. Now, whether it's a FICO score or a non-FICO score, either way, you can't buy anything with it, and you cannot compare it to the 3 algorithms that Fannie and Freddie have approved for mortgage lending. Aha, now we have some uniformity. When you pull in the mortgage industry, you have to use Classic 04, Beacon 5.0, and Empirica V2. You guys have seen those names on your credit report. And you thought, what is that? That's the trade name for the actual algorithm that is being used to crank out that score. That's all it is. And why are there 3 as opposed to just 1 algorithm for 3 bureaus? It's just a real practical reason. Fair Isaac Corporation can't design an algorithm that plugs into all 3 databases because they're different companies. They're competitors. They have different, they hold their data in different ways. And so Fair Isaac has to design different algorithms to crank out data in different ways, if that makes sense. That explains why when a customer comes to you and they've got 1 account and it's reporting the same across all 3 credit bureaus, why are all those 3 scores different? Well, Classic 04 is a little bit different from Beacon 5.0. That's a little bit different from Empirica V2. Okay. Now, when you pull in the mortgage industry, these algorithms are going to generate reason codes. There's 40 of them. I got them all memorized. It's super pathetic. I'm a credit nerd. But when you see those code 38, serious delinquency collection, public record filed, code 40, public record collection, code 10, proportion of balances on revolving accounts are too high. You see the English behind these codes. Well, that is actually created by the algorithm that determines score. Number 1. Number 2, those are listed in order of importance. Order of importance. And you can read them. Don't get lost in the verbiage. Just try to basically say, all right, if it says serious delinquency, they're talking about a late payment. Collections, judgments, that's in our wheelhouse. If the biggest thing holding back the customer is bad information, they need to give us a call. Period. We need to know about them. We need to do a full free analysis of what's holding them back and how long it's going to take to remove it. But when you see code 10, which is your credit card balances are too high, right? Or code 12, which is your overall length of credit history, then what that means is they might have negative information on there, sure. But what is holding them back overall is more items that are out of our control. So as we see a mortgage credit report, we figure out what's holding them back and how we're going to recoup those points. Does that all make sense? Cool. So moving on, these are the factors that determine mortgage credit. This is super important because we know how a mortgage score is formed. We need to know what factors determine credit. Sandy, you said a moment ago that you paid off a lease and your score dropped. Let's talk about that. 35% of your score is based on your payment history.
Yeah, you'd think I would have known better, but I just wanted my car. I wanted to buy my car and I wanted to not have a payment. And then the rates came down and I wanted to refinance, and 60 days wasn't enough time for my credit to recover from me doing the right thing.
Yeah, you're darned if you do.
What it is. I paid off something. I shouldn't have been punished for paying or buying my lease out. But
exactly. Somebody that buys out their lease, I'd loan you $20. You're not a risk. You're paying things off, right? But yet the bank takes away points. It's as we go through this, you might get a little bit angry. You might say, wow, they're really trying to show me in my worst light, not my best light. And that's the truth. They've got a really good system going where credit is this black box. Nobody knows what's in it. Nobody knows what factors determine it, but everybody blames themselves.
Well, I mean, as a consumer, I felt like it was a scam just to give me a higher interest rate. Mm-hmm. Because I paid off debt. I mean, because I paid off, I paid off a credit card too, because I paid down debt and bought my car. I got punished for that in the interest rate.
Correct. Yeah, no, absolutely. That's exactly how the system works. And that's why this information is so important. I want this information to get out there. If somebody's got bad stuff holding them back, that's my business. That's what I do. But if they don't have bad stuff holding them back, they should know this information. This should be available publicly. And you go onto the chat boards or credit repair companies, God forbid, and they put out bad information. And I take exception to that because that's really the fleecing of America. If you remember that old Tom Brokaw series, I dated myself, sorry. So 35% of your score is your payment history. This is what got you. It's like a big bucket of payments. The more payments you make on an open and active account, the more higher that bucket goes, the higher your score goes. And you get credit for a payment. It's called a month reviewed. If you've seen on that credit report, it says MR 99 or MR 12. Those are how many months that account has been reviewed. This also goes to another rumor. You can pay your credit card 5 times a month, 10 times a month. They will take your money any day of the month, but they will only give you they will only give you credit for a month reviewed once a month. So you will not increase your score by paying Capital One 10 times a week. Doesn't work that way. Or we would do it. Trust me. You get credit for a month reviewed simply by making a payment on time. If it's a good payment, it helps you. If you don't make it on time, it hurts you. And this is the section that it will count in. But what nobody knows is if you don't use an account for 6 months, then the date of last activity will age past 6 months. And at that point, your score takes a nosedive. All of the good payments that you've ever made on that account go away, and all the bad ones stay for 7 to 10 years.
Patrick,
Okay.
is there a rule of thumb about how somebody should be paying there? I mean, we hear 30% of the maximum credit. I mean, we hear all sorts of things.
Oh,
Pay
yeah.
it off every month and then charge something on it again. What do you feel is how do these people get like 815 FICO scores? Whereas one customer told me my FICO score is 1,000, which I didn't say anything, but I know that's
What do you mean
possible.
these people? What do you mean these people with 800s? What do you mean? Come on now, I'm feeling attacked. I'm gonna tell you all about this. This is very important. This leads up to this. But let's stay with payment history for just one more second, because again, these are just like a big bucket of payments. We're adding them up. If we don't use an account for 6 months, all the good payments go away and the bad ones stay. So yeah, paying off a car early or on time will cause your score to drop. Okay. If it's your final payment on a car loan, you got to make it on time, or eventually they actually will repossess your car on one payment. They will. So you have to make it on time, but you have to also know that 6 months later, you're going to take a drop in your credit score because you're going to lose credit for all the good payments that you make. Now, this is true whether it's an installment or a revolving account. The algorithm only sees 2 different types of accounts. You've got your installment accounts, which is just like your car lease. Your payment is the same every single month, and you have a definite payoff date. The terms are, 24 months, 36 months. You actually have terms. With a revolving account, and the most common example is a credit card. With a revolving account, the credit revolves every single month, and your payment will change based on how much you owe. So credit cards, department store cards, home equity lines of credit, okay? Now, all your payments for either an installment or a revolving account, they go right there into your payment history. And realize your revolving account, you never need to close it off. So this is one reason why we say credit cards are so important to credit score, because you never need to close them off. The payment you made on your Macy's card in 1982 can still be helping you if it's still open and active. Okay, that's very powerful. That can help you more than a mortgage, believe it or not. Okay, now Sandy was asking me specifically about balances. That's so important too, because that leads into the next section of credit. 30% of a customer score is based on amounts owed. That's your second biggest piece. Okay. And how much you pay on your installment loans has nothing to do with score. So your student loans, your mortgage, auto loans, how much you pay, or if you pay them off early, that can hurt you in terms of payment history. We just talked about it. But lowering those balances never helps your score. And we run into customers all the time that say, yeah, I paid off my student loans. That should help. And we go, oh gosh, that's money that maybe we could have put in a more optimal place, but good job getting off on the debt. That's bad, but let's kind of optimize that. Revolving accounts are where we normally will tell people to pay things down, because on a revolving account, the balance directly affects your mortgage FICO. How much you owe affects that, right? And you guys are hearing all kinds of crazy stuff like 30% or 50%. Let's talk about it exactly. If I only have one revolving account, it's worth 30% of my score. Okay. If it's maxed out, I'm losing all those points. Or if I have no credit cards, I'm saying no to 30% of my score. We have customers, especially in the Midwest, that say, I hate these banks. And I'm like, yeah, I hate them too, but you're paying like $1,200 for that truck, man. You need an open and active credit card. This is going to change your life. Because if you don't have a revolving account, you're saying no to 30% of your score. Okay. But if it's maxed out and you're using all that limit every single month, you're not earning any points. In other words, if they mail you a bill for your exact limit, you're keeping 0 points. If you can pay it down to 50% though of that limit, you will recoup 3/4 of your points. So most of the points you're going to earn or lose happen once that revolving account goes above 50% of the limit. But there's more points if we can pay it down lower than 50%, right? If we can get it down to 30%, that's what we're talking about, that will recoup 90% of the customer's points. 90%. In other words, there's 10% more points that we could earn, but we're getting the lion's share of our points if we can just get it down to 30%. We really hit diminishing returns on how many points we're going to get back if we pay it down lower than 30%. But this is a smooth curve. This isn't as if it's like a tiered system the way mortgage pricing is, where if I could just get to, 660 or 680, this is a smooth curve. The lower you get it, the better. But you hit diminishing returns on how many points you earn back. As you get below 30%, you get more and more points. As soon as you get to 0, though, something really bad happens. If you have a $0 balance, they don't mail you a bill, which you have the chance to pay on time. So they really have you in a catch-22 here. What do you do? The answer is really simple. We recommend people charge the smallest possible amount that they can on their credit cards or department-style cards, because that forces the company to mail the customer a bill, which they have the chance to pay on time, but is the smallest percentage of their overall limit. Now, as a side benefit, they're never going into debt. If you're putting a bottle of water on credit on your $200 credit card, you're not going into debt on that. And with a $200 credit card and a $1 balance, you're sitting at 99.5% available every single month. So for the customer that comes to us and they have no revolving accounts, we have them set up revolving accounts, and they say, what is the best way to use this? We don't say 30%, that's okay, right? But they pay us money to know the best way. And the best way is pay the thing to 0, because interest is evil, but charge up $1 once a month. That's so important, because then they mail you a bill and you're keeping that current activity while showing the most of your limit as available. Now, excuse me. This can also get a little bit complicated because customers think that the credit bureaus have real-time access to your balances. We live in this digital world where, hey, I just pulled credit and somehow this balance doesn't match what I paid off last night. Never does. The credit bureaus get notified once a month on the statement date, how much money is owed on that revolving account. Statement date. That's the date they state how much you owe to the bank, and they state how much you owe to the credit bureaus. And that number is set in stone until the next month's statement date. What this means is that the customer that maxes out their card every month and pays it off every month for miles or cash back, or, I do it. The problem, though, is that you look completely maxed out to the credit bureaus, because they never get the information after the due date on how much you've paid. If you paid it down to 0, you paid it down to $1, they never get that information. They're judging you on the worst day of the month. That's what they're doing. That's why $1 is so powerful. Now, if you have a business owner who has that habit of maxing it out and paying it off, and they're trying to get a home loan, they're trying to do something with their credit, very important that 1 or even 2 months ahead of time that they pay what they can afford online 1 day before the statement date. You can get your points, you can get your cash back, you can do all that, but 1 day before they mail the bill to you, literally 1 day before the statement date, pay everything down to $1 or $2. So they mail you a bill for $1 or $2, and you got to pay that. You got to pay that on time, of course. But that's the way you optimize how many points you're going to earn back from credit cards. Okay. The last thing I want to talk about with credit cards that I think everybody should know: this does not work like debt to income. I saw a video from one of my competitors that said, yeah, you just add up all your limits and you add up all your balances and you just pay down what you can afford. If that were true, you wouldn't have a what if scenario or a credit genie, right? Most credit vendors have these pieces of advice on the top of the credit report where it says, if you pay us some money, we'll teach you how to get 22 points or 12 points, whatever it may be. And they're going to tell you exactly which credit card to pay down and how much to get those points. That's proof that what credit card you pay matters. Okay. Now, how do we determine that? Number one, it's the percentage of the overall limit. How many points are being earned or lost? But the second thing, and this is super important to realize, is that each credit card weighs evenly on score. What matters is literally how much of the limit is being used. So let me be dramatic here. Let's say I had a $20,000 credit card and I had a $200 credit card, like a big one and a little one. They're both maxed out. I will get the same number of points by paying off the $200 credit card as I will by paying off the $20,000 credit card. Because in this section of credit, it's broken up amongst your number of revolving accounts. If I have 2 revolving accounts, each one is worth 15% of my score. If I have 3 revolving accounts, each one is worth 10% of my score. 30 divided by 3, right? And so you always want to pay down the smaller ones first. It takes less dollars to affect those percentages on the small credit cards, and also has that side benefit in mortgage of keeping more money in the customer's bank account, earnest money, cash reserves. It's a good thing to keep that in there, okay? But credit cards are very important. That is where you will directly affect a customer's score in a positive way, as long as they understand the difference in between statement date and due date, and the fact that they're just judged once a month on the worst day of the month. Does that make sense? Cool. So next section I want to talk about is new credit. This is where inquiries impact score. Okay. Pulling credit lowers your score. People want to ask me why. And that really goes to the motivation of Fair Isaac. I can guess, I can speculate. And my best guess is because they don't want you to figure out how the system works. They don't want you to know what I know, because if you knew that, you'd save money on all your loans. That would cost them money. But new credit is something that we help in this way. When a customer comes to us, we say, stop. You're in a hole. Stop digging. Don't let anybody pull your credit other than Cami or Sherry or Jessica. The idea is we want to keep people connected to you, because that's what keeps the deals flowing on our end. If we're closing deals for you, you keep sending deals to us. Pretty simple, right? But it's also the truth. We tell people, look, you're 580. You're not going to be magically a 640 tomorrow. And that loan officer that says, yeah, I can get you closed at a 580, that may be true, but ask them, how many of those have you done this year? Because it might be 0. As we know, sometimes those low FICO score requirements have so many overlayments that you won't actually get it closed at that level, right? Sometimes that's a pipe dream. Sometimes it's true though. I've seen some crazy stuff done, especially with the VA. Inquiries though, something you want to avoid, especially going to an auto dealership. We have customers go to auto dealerships and get shotgunned to 30 or 40 different banks, okay? And if you're trying to do something with your credit, it can be a really bad thing. And the customer only signed one piece of paper. All those other inquiries are illegal inquiries. Those are easy for us to delete, okay? Next section I want to talk about is length of credit history, because it's so important. You want to have the longest possible average length of credit history to have the highest score. It's sort of related to payment history, isn't it? Every single time you make a payment, you get credit for a month reviewed. In payment history, though, you're adding up those payments. Just simple summation. With length of credit history, though, you're averaging them. It's much different. An example would be if I had a 10-year-old credit card and I paid it every single month, 12 times 10, I've got 120 months reviewed. And that's pretty good, right? 10 years of credit history. But if I go buy a new car and I make an on-time payment to that car, which I have to do, that's a good thing to make your on-time payments, it lowers my length of credit history. It cuts it in half, because suddenly that loan is now 1 month reviewed. It's devastating. And this is why people should not be applying for new credit before they try to get into a home. There's DTI issues, obviously. There's the inquiry, okay? And there's the length of credit history issue. There's just so many reasons to avoid any sort of a purchase besides your mortgage when you're trying to get a mortgage, okay? Sometimes length of credit history we can manipulate, believe it or not. There's times where a customer has paid for a bunch of 0% interest at Home Depot or something, or furniture, and they say, yeah, I got the money. I always take the 0% interest. There are times where it makes sense to zero out that account, because you will then re-stretch that length of credit history once it's closed off. But you got to be careful. When you close off an account, you can't undo it, and you will lose credit for every good payment you've ever made. So to give you an extreme example would be that auto loan that I just made one payment to, and it lowered my length of credit history. If I had money to pay off the auto loan, I'd recommend doing that to re-stretch that length of credit history. Next section I want to talk about is your credit mix. You guys have probably heard that having too many credit cards is a bad thing, and that's the truth. But also having too many installment accounts can hurt you as well. It's a mix in between installment and revolving. And most people want to stay inside of a 3-to-1 ratio. If you have 3 revolving accounts, you can have from 1 to 9 installment accounts to balance that. Okay. But credit mix is something that you want to be very careful in manipulating. We do have customers come to us all the time and they say, yeah, I've got too many credit cards. Which ones should I shut down to raise my score? And the answer is none to raise your score. Absolutely not. No, don't touch them. Keep them open and active. After your mortgage is closed, though, if you feel you have too many bills to pay, if it's just too much, we can look at your credit report and we can make some suggestions within some bounds. And let me explain. If a customer's got a really good score, let's say they're already in almost to an 800, they're above 740, 760, and they have accounts that have not reported in 6 months, then I know those good accounts are not part of that good score, right? They're being actually ignored by the algorithm. And so technically, yeah, you could pay and close those things off. It wouldn't hurt your score. But as your credit score guy, it makes me nervous. I say, no, reactivate that Macy's card. Head back into Macy's and buy the Godiva chocolate at the register, the cheapest thing you can possibly get, because you're going to get all that payment history back. And you're going to go from 740, 760 to maybe 780 or 800. So I know paying bills is a pain. I don't like it. But it is the key to making sure that you pay less for your mortgage, your insurance, your car loans. Your most expensive purchases are all controlled based on this magical number. I mean, other than your total cholesterol, it may be the most important number you have. Now, when a customer comes to you, if you can't get them done just simply by paying down a credit card balance, okay? Getting people over to us is extremely simple. You just simply say, I'll have my credit analyst over at Mortgage Ready give you a call. They'll tell you how long it'll take, how much it'll cost. How does that sound? From there, you just send the name and number directly to our application. We've got a cool little flyer here that you can send off to the customer so they know what to expect. They can check out our Google reviews. They can check out our website. Your pipeline access is super simple. You just add a name and number. And then once you have active customers, they'll appear on your pipeline just like this. You'll be able to see the estimated date to pull. You'll have their phone number. You'll have all their contact information. We build that in there for you. So nothing slips through the cracks. And then once you see this little green outline, that means the customer's mortgage ready. They're good to go. But you already knew that because the credit analyst called you before you saw that. We know that if you're not on the app, you need someone to say, hey, I think this customer is ready to go. We want to make sure they get connected to you and they don't go off somewhere else, okay? The plan that we talked about, this really dovetails with the pie chart that we looked at. Now you guys really understand how credit's formed. You know the factors that determine credit. On the very top of the plan, we have a to-do list. This is typically credit cards. If you got $100 to throw at your score, we'll show you where to put it. If you have 1,000, 10,000, whatever it is, you know exactly where to put it to get your maximum gain back. If the customer has to pay or settle off anything, it'll be right here. We'll have a phone number. It's real simple. How much is being posted. And we'll actually talk to the customer about exactly what to say to the collection company before they make that phone call. And we have their back the whole way. Sometimes we don't do debt settlement, mind you. I don't believe in that. I haven't found a good company in America that does ethical debt settlement. Instead, we just walk the customer through and we hold their hand the whole way. Okay. And then the most important part is our to-do list. Our program is all about transparency and accountability. We put down a list of absolutely everything that we are going to be attempting to delete. We work under the Fair Credit Reporting Act, which is a federal law, and we're looking for errors, reasons why this account should not be posting on the customer's credit report. And it's no secret that we're the best at getting bad stuff to go away. And on the very bottom, we have the customer's estimated date to pull and some basic information about credit, like don't let anybody pull your credit other than Cami or Sherry or Shauna. We want to make sure people get connected to you, but the estimated date to pull is on there as well. So you know exactly when the file is going to be ready. The customer knows exactly when the file is going to be ready. They know exactly what their role in the process is and what our role in the process is. And, you know, we've been evolving this product now for 13 years. If you can think of any better way to help customers get into home loans, these big floppy ears, I'm all ears. This is how we get better, is by listening to loan officers that go, if we just had this, it would help. Well, I'm here to help. So let me know if you have suggestions. Now, affordability is unbelievable. You're never going to find a company out there that does a job like we do for what we charge. Our website says we're $219, but anybody that you send directly through the app, we knock $50 off right away. So it's only $169 to enroll. And that's, of course, after a full free analysis. Then the monthly fee is $149. Customers cancel anytime. And every month they're going to get an update saying where that money's going. Every month we're going to be telling them what has been deleted and what has not been deleted. We do a soft pull on the customer's credit report every single month. We do before and an after comparison. Again, we want to be transparent. We want everybody to know what's going on, okay? But the idea is we don't want you to throw away deals. If a customer comes to you and they're rolling late on a mortgage, you're probably like, oh my God, run for the hills. We had a customer that was rolling late on his mortgage. He was in the high 400s. 6 months later, we had him at a 660. So you never know who's going to turn their lives around unless you don't send us.
Do you want to tell them what a rolling mortgage late payment is?
Yeah. So if you don't make a payment on time, or let's say my mortgage payment is $1,000 even, and I'm making that $1,000 payment on time every single month, but 1 month I messed up and I paid them $900. I'm $100 short. They are not going to they'll take my $900. They will cash my check, but they will not mark me on time paid in full for that month. They will mark me late that month. And then that late next month will carry on. If I pay my full $1,000 payment the next month, I'm still $100 in arrears. Late. So the customer may be making payments every single month, and they may start to roll late on their mortgage. Of course, if you make no payments on your mortgage, 1 month, 2 months, that's a rolling late. 3 months. Once you see a 30, a 60, and a 90-day late payment, we know the account is rolling late. And that can be so dangerous. Of course, a 60-day late hurts you more than a 30. A 90 hurts you more than a 60. But once you hit 90 days on a mortgage style account, that can be viewed upon as a foreclosure, can create underwriting issues beyond underwriting issues. Many times we are hired to remove that portion of a mortgage that says foreclosure process initiated. Right? Once you're 90 days late, they're going to stamp your account with that foreclosure process initiated. And that can really change your options when you go to get a home loan. And once you catch that back up, there's no money owed. There was no foreclosure. Didn't happen. Well, we need to get that verbiage removed so the customer's options open back up.
So we have a bunch of people that can ask questions right now if you'd like.
Love it.
One thing I was wondering is, we will sometimes get people that do not have any credit, any established credit. How can they go about establishing credit?
Thank you. That's a really good question. So somebody that is young or they just came here from another country, what do? They open up revolving accounts. They do not open up installment accounts because I love it when you drive by a car dealership. It says buy a car to raise your score. That's a temporary thing. One day you're going to pay it off and your score is going to go down. And worse, that installment account does not work on that 30% piece of your credit that's controlled by revolving. So those are two reasons why I say get them a credit card style account. Now, most of the time they're going to have to do a secured account. Okay, there's a process where you pay money to a credit card company to secure that debt. And there's just two different types. They're the cheap ones out there, like Capital One, First Premier, right, where it's $150 to get going, but those have annual fees. And so that person that just came here for the country is going to have to pay annual fees for the rest of their life if they want to keep credit for that account with First Premier or Capital One or Credit One, all the usual suspects.
What about being added as like onto somebody's account? Does that help them accelerate the process of establishing credit? Like an authorized user, or if mom and dad put a child on account with them to help them start credit, does any of that help?
Always, 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 always helps. That said, a mortgage underwriter, if all you have is authorized user accounts, you're not going to get a loan to go through. Okay. But when you piggyback on somebody else's account, you get all of the credit history from the beginning of that account, not
So
from the
don't
date.
go for authorized user, ask them to be put on the account as a second user.
I always recommend authorized user. I never recommend joint. The problem with being joint on an account is then you're responsible for the debt. And if something were to happen, you're responsible for the debt on that account. A lot of our
Right.
customers that call us every day, they say, yeah, I only co-signed. What was the deal there? With an authorized user, you're authorized to use the account. The bank will most likely post all of the payment history to your credit report. The actual credit card doesn't go to the authorized user's address. It goes to the card holder's address. So if you're the mom and the dad, that's going directly to you. Your kid is not getting the card. You can cut it right up, but they can still get the benefit of all those years of payment history. We've had people, and it's been just smashing success. We've had people added to their parents' credit cards where the credit card was opened before they were born. So they were getting credit for payments, you know.
Yeah, being a junior, like that's the easiest way for, and my brother was also a junior. And we, of course, they didn't have credit scores in the beginning, but once they came about, and I remember looking at my credit report going, I didn't open that Sears card in 1972. I was 9, and in the beginning when they started with credit scores, we saw a lot of that juniors. Are you a junior? Are you a third? Because if you lived in the same house, they kind of picked it up and kind of moved it on your credit. Are those things that still happen now, or?
They happen in a bad way. They happen with collections. They happen they don't happen in a good way, where you get credit for an open and active good account like it used to be. I think it may have something to do with, was it 5 years ago where it became illegal to, open up credit cards for kids? I think that was a good thing.
Not me.
A little while ago, I know it was a good thing. But yes, piggybacking is something we always recommend because it's going to put you ahead. I mean, it's going to mean that your car costs less, your insurance costs less, your rent literally will cost less, even if you're not trying to buy a home. I mean, this is the magical black box, and everybody bleeds from it. They don't even know why. So yes, piggybacking. However, always open up accounts in your own name.
So piggyback mom and dad, and then go and open that. I think I'm trying to remember what the easy credit cards were to open. I think it was Sears at the time or what have you. Usually it's department credit. JCPenney's, they're usually the easier ones. How long does it take to establish a credit score once you've opened new accounts?
Great question. So the customer that has a true zero and they open up credit cards in their name, the mortgage algorithm will not generate a score for 6 months. You have to have over 6 months reviewed. Otherwise, you're going to see NR, not rated. Okay. And so it's very important that we get a piggybacking account in that case. There are times where, you've got 3 accounts in your name and you've got the length of credit history from the authorized user account. The mortgage underwriter can't say where the score is exactly coming from. They can't say it's entirely due to that authorized user account. And we've seen loans go through more quickly because of that piggybacking. You got to have accounts in your name.
Right. What about one other thing, Patrick? Sorry, because there's so much. I mean, we could talk about credit all day long.
Yeah.
Because I'm a mortgage geek, so I get it. But what I'm trying to do is just like the myth busters, kind of like, what can work and what can't work. So you hear about people having their utilities added to a credit report. They have their insurance added because they're under the impression this is going to develop a credit score for them.
Yeah, it can develop a credit score. It's not going to get you anything good. So basically, when the credit bureaus themselves develop multi-million-dollar software to probe into your bank account, they paid a lot of money to probe into your bank account, to look for recurring payments, to then set up shadow accounts. That's exactly how it works, okay? The reason they're doing that is because they've got everything on you. And once they see your bank statements, they got everything else. They're selling all that information off to Meta, Google, all these companies. To me, that's extremely evil, okay? To be honest with you.
So it
I don't like my
doesn't like,
information being off. But from a credit score perspective, still not a good deal. I
okay.
thought when Experian Boost came out that, oh, okay, cool. Here's another arrow. We're going to put it in the quiver. And when a customer needs a little bit more payment history, they just need a little bit of a boost on Experian, we're going to use that. But here's the problem. These installment accounts, these contracts, right? They refresh every 1 to 2 years. And so as a customer adds these accounts on there, they're invariably lowering their length of credit history. They're adding extremely young accounts on there. They'll say, oh, my cell phone's been open for 10 years. Yeah, but you're getting like 8 months of payment history for it because your contract renewed. Sorry, that's an 8-month account. And so we spend more time telling customers to remove Experian Boost. There's times where we see people are 20, 30 points lower on Experian compared to the other two bureaus. And on Experian, we see that code 12, length of credit history, is hurting the customer. That is
So the only
definitive.
time that it would be recommended is if we as loan originators are working with a customer, and generally FHA and the VA are the only ones that are really going to do a manual underwrite for somebody that has no credit. That is the time where you can call up the credit companies and ask them to add those references, the rent, the utility, the things that we require for people that have no credit. Sometimes they like that to be added to the credit report, but
Yeah. And you
that
can
would
get a
be
loan done that way in those circumstances.
right. So
Absolutely.
that would be really the only time that we should really recommend people do that then. So there's so many
Exactly.
myths out there and there's so many things and it gets very confusing for everybody. Does anybody else have any questions for Patrick before we let him go today?
I do.
Go for it.
As far as the authorized user, can you have multiple authorized user on one account? So you're saying to piggyback parents, if they have siblings, can all the siblings be? Or do they need their
Yes.
own separate? Okay.
The bank itself will limit how many that it can actually be done. The reason why I know this is because there are companies out there where you can pay money to them and they will add you to their credit cards. We don't partner with any of those because frankly, it's shady. It can create underwriting issues. We always want it to be a friend or a family member of the customer, and it's no expense to the customer. It's not like, $5,000 for a magical credit score that might never appear. But each one of these accounts has a limit to the number of authorized users. It depends on the company, but I say 3 to 5 is a good, unless it's a business account, of course. Business is a totally different deal, but with a personal credit card, you're looking at about 3 to 5 authorized users. Good question.
Okay, thank you.
Yeah, and I love the piggybacking. It's you hear these rumors about piggybackings going away, and it's true that a mortgage underwriter can look at it and say, if that's all you got, I'm not giving you the stamp of approval. But that's why the customer needs open and active accounts in their name, and there's no reason not to do an authorized user account as long as that account is long-standing. I want to see months reviewed. I want to see an old account, years and years of positive on-time payment history. And of course, balance matters. We don't want to be adding somebody to a maxed out credit card. There are times where customers come to us and they say, please remove me. I'm on an authorized user account that's killing my score. Can you help me? And it's an easy removal from our end. It's not a problem. But in general, most people are helped by the piggybacking as opposed to hurt.
Okay. So Patrick, how would the members here be able to reach you if they had customers? What's the best way for them to reach you if they have people that they want to refer to you that maybe are not ready to get a mortgage yet, but maybe we can get them ready in 6 months to a year?
Well, we want to make sure they have a go-to source at Mortgage Ready. We don't want to just send them to the website or a phone number. I want to introduce them directly to a credit analyst so they know exactly who will be calling their customers. This credit analyst is going to know exactly how you like things done. Do you like to share credit reports or not? how does your underwriting work? Every company is a little bit different, right? And so I want to make sure that I assign a credit analyst to everybody. And so if you can just send me a list of all the attendees, I'll make sure that I copy that into my credit analyst. I'd like to assign you guys over to Jenna. She's amazing. She worked at Factual Data for like
Okay.
10 years before we hired her. So it was like this amazing score. She's been with me for just over 2 years now. So you're getting a veteran who really knows her stuff. But I'd like to connect you guys so you know exactly who is taking care of your customers. And so when a customer is mortgage ready too, that you get a phone call from Jenna. Because sometimes I think we want these to go through more than you do. Because we know, if we get somebody closed, well, we get 10 more leads out of that.
All right. So if, let's see, if we have, Janelle, Cami, Sarah, Shauna, Sherry, if you guys put your email in the chat box, I will make sure that Patrick gets them and he can send you the information on what you need to do. And Patrick, just to reiterate, you are in all 50 states, correct? Because we have
There's
people in
one-
here from California, Texas.
Beautiful, beautiful. Yes, every state but Michigan, unfortunately.
What's
Michigan has a
what's
lot.
what's the gig with Michigan?
Well, Michigan has a very specific law that says that if somebody is in credit repair and their ultimate goal is to get a loan, that you can't charge them a penny until they're in their loan and closed.
Oh,
And
that's
frankly,
kind
I
of like
can't.
a rapid rescore kind of thing. We can't charge them for that.
Yeah, in Michigan. And so it's one of those things where if I were to run a business out of Michigan, I would get burned on so many deals, frankly, that I'd have to charge people that did pay me so much more that it would destroy my brand. In other words, if I was doing $500 monthly payments out of Michigan, because 1 out of every 5 people paid me, that would destroy my brand. People would say, wow, Mortgage Ready is incredibly overpriced, and it's not worth it to me
Right, got you.
to
Okay.
price that in.
Does anybody else have any questions before we let Patrick go? We all got to start our day.
Yeah.
All right. Well, Patrick, thank you so much for coming in and talking to
Thank you.
everybody. I will get you their emails. They're putting them in now and I'll send them to you. And then this video for my members is going to be archived in the video library. So you can go in and watch it again anytime you'd like. And also don't forget, we have credit modules that also do give you detailed instructions on how to read a credit report. I always say a credit report is like reading somebody's biography. So and so we train people how to read the codes and everything on the credit report. So those modules are all uploaded, self-paced training, and don't forget the mortgage support room, everybody. All right, Patrick, thank you so much.
Thanks, everybody. Appreciate your time.
Okay,
Thank you,
take
bye.
care.
Take care.